Hey everybody, I'm David Warshaw, Certified Financial Planner at the Wealth Clan LLC, and today we're breaking down one of the most basic but misunderstood parts of investing, the difference between taxable, tax-deferred, and tax-free accounts. Let's get to it. Now, we all understand the importance of investment diversification, but it's also important to diversify those same investments using different account types. Having money in different buckets, taxable, tax-deferred, and tax-free, gives you options. It gives you control. It gives you flexibility. It's kind of like building your own tax strategy menu for the future. Because let's face it, you just don't know what tax rates will look like 10, 20, 30 years out, or what your income is going to be when you actually retire. So flexibility is power, and tax diversification gives you a ton of it. Now, I'm not going to dive in this video with all the fine print for each account type, but just give you a general overview. We'll save those details for future videos. First up are taxable accounts. These are basic brokerage accounts that could be individually or jointly owned, revocable trusts, or UTMA accounts for your children. UTMA just stands for Uniform Transfers to Minors Act. Now, here's the deal. There's no special tax breaks on these accounts. You'll pay capital gains when you sell something for a profit, and you'll also get taxed every year on any interest or dividend income that you earn, even if you don't touch the money. Basically, you're investing with total flexibility, but Uncle Sam gets a bite each and every year. And UTMAs do give your children a tiny tax break up front, which is nice. Thanks, IRS. Next up are tax-deferred accounts. Think traditional IRAs, 401k, 403b plans, SEP IRAs, simple IRAs, and other employer-sponsored retirement plans. Now, these accounts give you a tax break right away, which means you're either contributing pre-tax dollars, like money taken directly from your paycheck before taxes, or you're getting a tax deduction or write-off when you file your taxes. So the magic is that once the money's in, it grows tax deferred, which means you're not paying any taxes on dividends, interest, or capital gains. This is where the power is, because the government isn't dipping into your growth every year. Your money compounds faster. But there's a trade-off. When you withdraw the money in retirement, you'll owe ordinary income taxes on every single dollar. So you're not really avoiding taxes, you're just deferring them and taking advantage of the growth potential in the meantime. So it's great for lowering your taxable income now, but just remember, your future you will be footing the tax bill later. And finally, there's tax-free accounts. This is the holy grail of investment account types. We're talking Roth IRAs, 529 college savings plans, and HSAs. So here's how these account types work. You pay taxes now when you put the money in. There's no upfront break, but the money can grow tax deferred, and if you play by the rules, be withdrawn tax-free. Roth IRA, tax-free retirement. 529 college savings plan, tax-free if used for education. HSA, health savings account, tax-free for medical expenses. So yeah, you're paying the IRS up front, but after that, it's hands off. Don't touch my money, IRS. Now let's zoom in on the health savings account for a second, because this is like the Swiss Army knife of tax-advantaged accounts. It's the only account that gives you a triple tax benefit. You get a tax deduction when you contribute, even if you don't itemize your taxes. 2, it grows tax deferred. And 3, if you use it for qualified medical expenses, the withdrawals are also tax-free. And here's the kicker. Once you hit age 65, you can use the HSA for anything, not just medical. If you do, you'll just pay regular income taxes like the traditional IRA. So worst case scenario, it becomes another retirement bucket. Bottom line is the HSA, the health savings account, is a tax unicorn. No other account gives you that triple tax benefit, and way too many people overlook it. I want you to pull back and notice how with all of these different tax shelters, the government is incentivizing you to save for something. Retirement, healthcare, college, because those are massive expenses they'd rather not cover on their balance sheet. So take advantage of the tools they're handing you. They exist for a reason. So to sum up, Taxable accounts are like regular brokerage accounts where you can invest in anything you want for the most part. The IRS just takes their cut every single year. Tax-deferred is a deal with the IRS. They'll wait, but they want it all later. And tax-free is a gem. You pay now, and you're done if you play by the rules. So here's the big takeaway. You want to start funding each of these account types every year if you can. Some years you'll want the flexibility of a taxable account. Other years you'll prioritize the tax break from your IRA or 401k. And whenever possible, you'll want to build tax-free wealth in your Roth IRA, HSA, or 529 college savings plan. The goal is tax diversification. And that's how you build a retirement plan that's not just smart, it's tax smart. Having different buckets gives you choices. It gives you control. And that, my friends, is tax smart investing in a nutshell. See you in the next video. Take care. Bye-bye.